Concessions, and welcome to the 10th episode of the One Bite at a Time show, where we research the most relevant information to your business in today's market. And we bring it to you one bite at a time, because how do you eat an elephant? One bite at a time. So I'm Roxann Hayes.
And I'm Steve Gronlund, and we're both with Vintage Mortgage Firm. So Roxann, what's the plan for today?
So for today's bite of the day, we're going to talk about a very popular strategy that a seller can provide to buyers instead of just reducing its sales price.
That's right, Roxann. We're going to talk about the buy down. But let's just talk about the market a little bit more, because I think that, a lot of people don't realize we're going back into what really is a normal market. I don't think we're going into an unusual market. We're going into a normal market. We've been in an unusual market. Wouldn't you agree, Roxann?
I would definitely agree with that. When I got into this business, I remember a realtor who sold a house in, 2 weeks, and everyone was celebrating. And a realtor told me, well, if a house sold within 2 weeks, maybe it just wasn't priced right.
Yep.
Meaning the seller should have received more, and the house shouldn't be sold in 2 weeks.
Right. We're going back into those normal days today. I know nobody likes change. Well, I guess a baby with a dirty diaper likes change, but that's the only thing I can think of. Only person out there that likes change. The older we get, the less we like change. And so that's what we're just seeing today. It's some change. We're going back into a normal market. We might even flip into a little bit of an unusually strong buyer's market for a short period of time. That would be maybe my guess. But then we're going to kind of level off into what we know the prices are going to be. We know what the market's going to be showing. The interest rates are going to be leveled off to something that's normal. And that normal we've been talking about for years was somewhere between 5 and 7%. And that's kind of what we're probably going to see in the near future. At least that's my guess. But there's other ways to entice buyers besides the buy down.
Okay, lower purchase price. That seems to be the go-to right now for sellers, is just lowering the purchase price.
Right, but that also lowers the commissions, and that also affects the prices of the houses around them. And so that's not necessarily what we in the real estate industry want to see. Of course, the seller can pay for closing costs. Well, that would mean we're back in a buyer's market if that happens soon. And that is just simply have the seller pay for all the closing costs. If it's a VA loan, 100% financing, and the seller's paying all the closing costs, it's a no-no, VA no-no. We haven't seen one of those, very popular for a long time because it's been a seller's market. Sellers weren't willing to pay the closing costs. But you can have the seller pay closing costs, a portion of the closing costs or all of the closing costs. Another option is furniture, equipment, that are going to be transferred over with the house. A lot of people have good furniture, nice furniture that might not match where they're going, or they don't want to carry it and move it, so they can offer it as an incentive for the buyer to buy their house. That's an option. I've even heard of people selling the old Corvette in the garage with the house.
Steve, sellers are also having to actually present their home to be sellable. A lot of times during this past year or so, people were just trying to sell their home as is and not putting in the work to make the house sellable at its best price.
Right. Oh, I see. And another way to entice the buyer to buy a home is the seller's going to make some repairs that they wouldn't have normally made. They're going to make those repairs. We might see more of that, in a strong seller's market like we've been in for a long time. We've seen sellers basically put their home on the market, sell it as is. No repairs will ever be done. I'm not going to do any repairs, whether you want them or not.
And just to note, for all the agents watching, if you do decide to do a credit, it's not a credit for repairs.
Yes, never say the credit for repairs, because then the underwriter is going to want to see a home inspection and it's all new open can of worms.
That's right. So credit for occurring and reoccurring closing costs.
Of course, this message is about the buy down, and I'm going to be explaining that in detail right now. Hi, folks. So we're going to go through some examples and talk a little bit about the 2-1 buy down and the permanent buy down, and how that might be a great option for sellers to use in place of reducing their sales price. Here we go. All right. So first of all, I want you to understand the buy down process. Okay. The seller pays points. Basically, they're paying points on behalf of the buyer to buy down the interest rate, either temporarily or permanently for the buyer. So the seller's paying points to buy down the interest rate, either temporarily or permanently for the buyer. And that is going to give the buyer some value. It's going to help the buyer to give them a chance to ease themselves into the payment. And it's going to give the buyer a savings on a monthly basis for the first 2 or 3 years, so that maybe they have the money to redirect towards furniture or some repairs they want to make or home improvements. And it's going to provide a purchase incentive during different markets. So the idea is when markets change and it becomes more of a buyer's market than a seller's market, sellers have to come up with ways to entice buyers to buy homes. And so although it's not there yet, it will be. We're going to see different markets in our careers, right? But we need to understand this concept completely so that we know how to solve problems for our sellers and our buyers. So let's take a look at an example of a 2-1 buy down. First of all, I want you to understand that there's a 3-year buy down, a 2-year buy down, and a 1-year buy down. And they're normally looked at as a 3-1, 2-1, or 1-1 buy down. And so how does that work? So this is how it works. Here's an example. It can be done, by the way, on a conventional loan, FHA, VA, or USDA loan. So let's just say the purchase price is $500,000 and the loan amount is going to be $400,000 on a conventional loan, for example. The note rate's going to be 5%. So the seller is going to pay points up front to buy down the rate. For example, in this case, the seller would be paying about 3 points because that's how much the lender is going to cost the lender. So they're going to do a 2-1 buy down. So for the first year, the interest rate, or I should say the payment rate, because the note rate's still the same at 5%, but the payment rate for the buyer is 3%. The payment will be $1,686 instead of what the note rate payment should be, which is $2,147. Understand the buyer is saving $461 for the first year. Now, that money is still being paid to the lender, but what's happened is the seller has paid points and that money goes into a reserve account. And every month the monthly payment is made. $1,686 comes from the buyer and $461 comes out of that reserve account that the seller created when they paid or prepaid those points. The second year, the payment rate is 4%. Now that means their payment is $1,910. It's gone up, but it's still less than what the payment will be at year 3, which is $2,147. Again, the difference is coming out of that reserve account when the seller paid the points and the full payment is being made to the lender. And of course, the third year, the rate is 5% again. And the payment is $2,147, just like it should be, and every year after that. So there's a certain amount of money the buyer saves, about 3%, 2% for the first year, and 1% for the second year. So about 3%, which is incidentally about how much it costs for a 2-1 buy down, where the seller is paying those points. I hope that makes complete sense. If it doesn't, you need to call me so we can make sure that we're clear on that. The permanent buy down is different. It can also be used on a conventional VA, FHA, USDA, and the jumbo loan. So a permanent buy down is a little different. For example, in this case, the purchase price is $500,000. The loan amount is $400,000. The current interest rates would put you at about 5% with no points, as an example. Monthly payment is $2,649. The seller pays points up front to buy down the rate, but this is permanent. So for example, in this case, this is a VA loan and the seller is going to pay 4% or 4 points on a VA loan, which is the maximum concession they can make. So let's say they're going to pay 4 points. The permanent bought down rate is 3.5%. So instead of 5, they're getting 3.5% with 4 points. Now, 4 points, which is 4% of the loan amount, can be a lot of money on a $400,000 loan, as an example. But that's going to buy down the payment to $2,216 a month. Now understand, the note rate is 3.5%. It's not a payment rate for the buyer. It's the note rate. That's never going to change. The savings is $433 per month. That's a lifetime savings on a 30-year loan of $155,880. That's where paying points can make a lot of difference. Now watch out though, we have max seller concessions. So on a conventional loan with less than 10% down, the max concession is 3%. On a conventional loan with more than 10% down, the maximum seller concession is 6%. VA maximum is 4%. FHA is 6%. USDA is 6%. Understand that you need to watch out for the max concessions when you're structuring these deals. And the market changes daily. Sometimes the permanent buy down doesn't make sense. Sometimes it costs you 1 full point to buy down the rate just 1/8%. In those cases, it might not make sense at all to do that, but the 2-1 buy down never changes. The 2-1 buy down is always the same. 2 points less than the note rate for the first year, and 1 point less than the note rate for the second year, and then the note rate from that point forward. So sometimes one might be better than the other or make more sense. Someone would use the 2-1 buy down or the permanent buy down in order to entice buyers to their sales, or in order to help buyers ease into their new payments or buy furniture or make improvements to the house during the first few years. So I hope that makes sense to you. A buy down is very popular, especially in a buyer's market. But as things change and the market change, you're going to see lots of good reasons for buy downs. We've even seen them during the seller's market. But understanding buy downs is important to you and all the different options. There's a 3-1, 2-1, 1-1 buy down. Those are temporary buy downs. And then, of course, there's a permanent buy down. And one or the other might make more sense depending upon the market of that day. So I'm available if you have any questions on these. If you want to price anything out, give us a call. We'd love to help you. Hey, Roxann, I see you have the new mug in your hand. You got what, whiskey in there or coffee?
You'll never know.
Guys, you know you can get one of these mugs. We want to send it to you. All you got to do is register for the show. Go back to the email you got with this show and register for the show. Also go on to our channel on YouTube, the One Bite at a Time show at Vintage Mortgage Firm, and subscribe to us there. Do both those things and we send you a mug.
Check it out, guys. Here's our One Bite at a Time show mug.
You can put whiskey in it, coffee in it, money in it. I guess you could put brandy in it, wine in it, pens, flowers, or I guess you could put coffee in it. Speaking of listings and sales, here's some examples of some rather strange listings.
This is Tabitha Mays, I believe, in Hermosa Beach, California. This is a 3-bedroom Mediterranean-style home. This is the outside of it. That looks fine. That's nice. Let's see inside. There's the living room. That's a fireplace. That's the bathroom. The house, it says, has 3 bedrooms, but it doesn't matter because you're never going to be able to sleep. That's creepy. I wonder who's selling the house. Let's look at the realtor. It's Chucky. I see. That's right. You don't understand the doll in every room. Angie Madeline in Asheville, New York. This house is it has a home office, it says. There, and then. Well, that's good. So when your secretary's working, you have the privacy of the wall. That's fine.
I can't think of nothing else to say, nothing else to say, nothing else to say.